Okay, and I am a little behind on posting the recording, so give me some time. I'll make sure and spend some time doing that tomorrow and this weekend to get it caught up, including tonight's lecture. If you're taking the BEC class, I think I'm caught up on, well, I didn't put last night's up yet, but or I don't know, maybe I have put Tuesdays up. I'm not sure, but I'll get those caught up. Okay. With that, we're going to try to finish up chapter 3, although I think that last module will probably push until next time. We finished talking about fraud. We didn't quite finish that up. We got through it substantially, but there are a few pages left there. But remember that fraud risk assessment is a 10-point area on the exam. You need to finish that material up. You need to look at that. You need to be very good with that fraud related material. So we're still in the area of assessing risks, and then we're going to start to talk about evidence and generally speaking about evidence and trying to evaluate the sufficiency of that evidence. And then that's going to lead us to discussion of audit sampling, in which we'll use sampling techniques to help us determine do we have sufficient evidence to support our assessment of risk of material misstatement, particularly the inherent, the control risk part of that, and then the detection risk part of our audit risk. Audit sampling is not particularly heavy on the exam. It's a 5-point area on the exam, but sometimes students need a little extra help with that. So we'll spend some time with that tonight. And then towards the end, we do a little bit of discussion of data analytics, but I think we'll probably get to that next time. So with all that as just a kind of brief overview as to where we're going, remembering that you need to finish up that module, which was module 1 on fraud. And now we're going to continue in an area that is similar to fraud, but different in that we're talking about compliance with laws and regulations. Now you say, well, gee, isn't non-compliance fraud? And it could be, but is it possible for an entity not to comply with law accidentally? Sure. Okay, maybe some of their employees or something are doing something that's not in compliance with the law, or maybe the entity themselves didn't realize what the compliance requirements were and they end up not complying. Regardless, management is responsible. Management and those charged with governance are responsible for trying to ensure that the entity operates within the compliance with the laws and regulations, including laws that are related to the operation of the entity, etc. Okay. Now it also will hit what potentially, compliance that is relevant to the financial statements. There are a lot of laws, and some laws may not be as relevant to the financial statements as others. So when we start to understand auditors' responsibility, the auditor is responsible for obtaining reasonable assurance that the financial statements are free of material misstatement due to non-compliance with laws and regulations. However, and this is an important however, the auditor is not responsible for preventing non-compliance and cannot be expected to detect non-compliance with all laws and regulations. And this is the part I want you to flashcard here. The further removed the non-compliances from the financial statements, the less likely it is that the auditor would recognize or detect, is probably a better word, the non-compliance. Okay, now what does that mean? Let's say that an entity doesn't file its tax return. Are they in non-compliance with the law? Yes, of course. You're supposed to file your tax. Well, you have to file a tax return, right? Go ahead, try not filing one from some time to see how the IRS treats you. Okay, so entities are required to file a tax return. Okay, even if you're a not-for-profit, you have to file an informational return in 990. So yeah, entities have to file tax return. Now, let's say it's a commercial entity and they file their tax return. Is it possible that there's a difference between the tax liability following the tax law and the tax liability following US GAAP? Yeah, Okay, we call this deferred taxes. Well, deferred taxes is a major component of the financial statement, requirements, right? I mean, when I say major component, it's a big deal. People are all, there are people I had as former students, many of them, that's all they do is sit there and figure out what is the deferred tax liability, what is the deferred tax expense, the current part of the tax expense, et cetera. So it's what? Filing the tax return is very closely related to the financial statements. So the auditor would, as part of doing the deferred taxes, say, hey, may I see your tax return so I can start to understand the difference between what you're putting as your tax expense based on your tax liability versus your tax expense versus on GAAP. And at that point, the entity would have to say what? I didn't file a tax return. So the entity would know that there's a chance of material misstatement of financial statements because of non-compliance with law. Now, that would be different than, say, the entity has to follow laws related to OSHA, safety rules and whatnot. Now, we're not saying that the auditor will ignore those, but that's something that's what? Probably further removed from the financial statements and therefore less likely that the auditor would detect that. That's the way you need to look at some of these laws, because there are a litany of laws that can affect an organization, and the auditing standards don't expect the auditor to do a straight compliance audit of every single law that the entity may be subject to. Okay. Now you come over and they tell us that the potential effect of inherent limitations on the auditor's ability to detect material misstatement are greater for material misstatements due to law and regulation. So what they're telling us is we have what? More inherent limitation. And some of the reasons here are many laws relating to the entity's operation do not affect the financial statements. As I just mentioned, an example, maybe OSHA laws. Non-compliance may be concealed through collusion, forgery, etc. Okay, so for these reasons, why don't you go ahead and flashcard these? We're going to see that the inherent risk is going to be up for detecting those laws that are further removed from the financial statements or because of the concealment. If my inherent risk is up, the auditor may want to do what? Depending on how closely they think that non-compliance is related to the financial statement, the auditor may want to look for controls that will prevent or detect that misstatement, or the auditor may want to do what? Increase substantive testing to lower detection risk in response to this. Okay. Now we come over and let's take a look at this a little bit. Liking where I've placed this. Okay, so what is the auditor going to do? Well, they're going to obtain an understanding of the entity and its environment. Okay, and the auditor should obtain sufficient appropriate audit evidence regarding material amounts and disclosures of financial statements that are determined by provision of law or regulations that have a direct effect on the financial statements. Again, direct effect, okay? That phrase being something like the example that I've given, the deferred taxes, et cetera. The entity may specifically have disclosures about compliance with laws and regulations in their financial statements. Obviously, the auditor is going to want to make sure that those are properly disclosed and footnotes and whatnot, but still, there's the idea that if something is determined to have a direct effect on the financial statements, the auditor is going to want to make sure that they have evidence regarding whatever is being put into the financial statements regarding those direct effects as determined by provisions of law. Okay. Now we come over and we say that for the purposes, for the provisions of laws and regulations that have an indirect effect, again, I'm using that example of the OSHA on the financial statements, but have a fundamental effect on the entity's operations, the auditor should perform the following procedures. So we have direct effect ones, and we're really going to have to get evidence. For indirect, okay, some of the things that we're going to do is we're going to inquire of management about the compliance with those indirect laws, inspect correspondence with relevant licensing regulatory authorities. Okay, so let's say you have a importer and you have an importer that is subject to laws related to Department of Homeland Security, customs, that sort of thing. Well, if they have correspondence from them, and often the correspondence will say, we have determined that there's potential violation and whatnot, well, then, even though those may not be specifically related direct effect to the financial statements, there's an expectation that the auditor would look to see that there's the proper disclosure about a pending action or something from a potential regulator like that. Okay. Okay, good. And then you can see this last point here, the auditor should consider the evidence gathered in other audit procedures that may reveal instances of non-compliance. For example, let's say you're just auditing disbursements, okay, and all of a sudden you see a large disbursement and it's to a regulatory entity. That might be what indication of a fine. And therefore, we're looking to see that there was, the non-compliance was properly disclosed. Okay. Okay, good. Now we come over, and when you discover that there has been some sort of non-compliance, and this is very similar to what we said about the fraud, the auditor should discuss that with one level above those that are involved in the non-compliance, and in some circumstances with those charged with governance. As a practical matter, unless it was something like, a one-time parking ticket or something of that nature, during their deliveries, they double parked and they got ticketed for that. I would think that most non-compliance would probably go to those charged with governance. If it was a habitual thing that was causing material amounts of tickets and whatnot, maybe even that would go to those charged with governance. Okay, now let's come over though to the next page, and let's take a look at when we will definitely need to report things to those charged with governance. And notice that they are not involved in management, then we would want to report matters involving non-compliance to those charged with governance, because they're not involved in the day-to-day operations of the entity. We want to make sure they're aware of those kinds of things, unless they are clearly inconsequential. A one-time parking ticket, okay, you don't need to run up to the board of directors for that. But most things, when they say unless it is clearly inconsequential, that's standard speak for telling you report everything up there, unless it's just some really nonsensical, little nonsense kind of thing. If the non-compliance appears to be intentional and material, the auditor should communicate the matter to those charged with governance as soon as practical. Again, unlike fraud, which we have defined as intentional, non-compliance could be unintentional. And again, if it seems to be intentional, you would want to report that up. Now you can see also that if management or those charged with governance are involved in non-compliance, so now it's getting up to a high level in the organization, the auditor should communicate that to the next higher authority. And if there is no higher authority, the auditor may need legal advice. And what word do you think that's going to lead you to? Okay. If it starts getting that bad, that, you've got a management that lacks integrity, you're worried that they're intentionally violating laws, that's probably a good signal to have yourself consult with your legal counsel and withdraw from the engagement, right? Shake the dust from your feet and get away from that situation. Okay. Okay, good. So why don't you go ahead and flashcard that? Even though the standard doesn't say consider withdrawing, we're certainly heading towards that. Okay, now in the following circumstances, we may need to report non-compliance outside of the entity. And let's flashcard this. So notice, guys, and this is something to keep in mind when you look at questions dealing with talking about, because sharing information with those outside of the entity. Notice that we really heavily rely on the corporate governance structure for those charged with governance to sort of do their job and work through these issues. Okay, so the times when you speak outside about violations of law, these sort of things are very, very tightly defined. Okay, so let's just look at that, because the questions like to try to trick you into thinking that you should, pick up the phone every time you find fraud or non-compliance and start broadcasting it. And notice that it's a very tight list as to when you will go outside. Remember, we had said that the predecessor auditor needs to answer inquiries of the successor auditor. Okay, so one of the questions that the successor auditor, the auditor that takes over, is supposed to ask is, well, did you find any fraud, non-compliance? So we would be obligated to disclose that to the successor auditor as the predecessor. Okay, in response to a court order, there is no I know in California and in most states, there is no CPA client privilege. Okay, that's why sometimes you'll hear on the advertisements for this. I would always hear this. Moskowitz was always talking about helping people with tax. And
it's funny that you say that, because that's my boss.
oh, is it? Okay. All right. So you work for them and you hear him talk about tax, and often he says, hey, don't limit your client privilege. Make sure you talk to an attorney, right? Well, that's because CPAs don't have that client attorney privilege. And so a CPA who's an attorney, then, he obviously would be able to provide that privilege under the legal authority as an attorney, not as a CPA. Okay, interesting. Okay, good. Now, in compliance with the requirements for the audit of entities that receive federal funding, what happens there is if you are engaged to do what they call a single audit of an entity, then it is specifically required that you test compliance with very specific laws related to the program under which the entity receives funding, and you are required to report publicly what the non-compliance is that you identified. Of course, those reports are shared with the funding agency, but they're also public. Okay, so notice here, guys, very tight list as to when you are to go outside of the entity to report matters of non-compliance. Now, let's take a look and see how non-compliance will affect the auditor's report, and if it is what? Material effect on the financial statements. Don't look at the book, look at me. What do you think? Financial statements are materially misstated because of non-compliance. What do you think? What are my options in my report? Good.
Or adverse opinion.
Good. Okay. And I ask you to kind of think through that, and thank you, Eric, for that, because what? You've got to start thinking in those terms, guys. You're not going to sit there and be able to memorize every single time this, that, or the other happens. What is the effect on the report? You start to get more generally familiar, comfortable with the language. What? Material misstatement. We're talking what? We're talking qualified or adverse, right? Insufficient evidence. What are we talking about there now?
Qualified or disclaimed.
Good. Okay, excellent. Okay. And if the client refuses to accept the auditor's report, what should we do? Withdraw. Okay. When you start seeing the phrase client refuses, okay, you're often heading towards withdraw. Okay. Or what? You starting to feel that, those charged with governance are involved, but be careful with this whole withdrawal thing, because the CPA exam loves to list withdrawing from the engagement as an option. And they put some small thing, like not small thing, but something like management would rather the auditor not confirm the accounts receivable. So they set you up for this adverse relationship with management, and they'll offer withdrawal as a solution, and your reflex is going to be, oh, I got to withdraw because I'm having disagreement with management. Well, not necessarily, because you could perform maybe an alternative procedure, and maybe that's what the thing is offering you as a solution. So withdraw from the engagement usually means management is refusing, management is suspected of intentional violation, fraud, dishonesty. You start seeing those words, yeah, then withdraw. There are a few instances in which the standards tell us you have no choice, you have to withdraw. For example, if we're not independent, then we have to withdraw from the engagement immediately, that kind of thing. But it's usually something that's just, pulling out a major tenet of what we're required to do or what our overall philosophy is, that would cause us to withdraw from the engagement. Okay, good. Any question? Okay, now let's look at estimates. Okay, and it's interesting the way they put together the whole notion of estimates here, and that they start talking about identifying risk associated with accounting estimates here. And then they talk about how the auditor responds to the risk of misstatement due to accounting estimates in another section of the textbook. And I find that a little annoying. Why can't we just talk about accounting estimates all in one place? Okay, so they kind of got a little too, in my opinion, I don't know, religious in how they looked at this. And that since we're talking about assessing risk, we're talking about assessing the risk related to estimates here. And then we'll talk about the substantive procedures related to estimates when we get to substantive procedure. Well, I'm not sure that that's the best way to chop up the discussion. So what I want you to put here, okay, is develop independent estimate. I mean, this is what you do. Okay, when we talk about estimates, okay, you will assess the risk and whatnot. That says develop independent estimate, not very clearly. That says develop independent estimate. But this is what you do. You assess the risk the way they're going to talk about here, but your response is going to be develop your own estimate, compare it to management's estimate. And if you agree, you're done. If you don't, then you're going to ask them to, give justification as to why their answer is better than yours. And if they can't, you want them to go more with your estimate. If they refuse, what are you going to do? They refuse to adjust the estimate more in line with what you're saying?
Disclaim or withdraw?
I would think you would, in that situation, Michael, unless you don't have the evidence to develop an independent estimate, which I'm assuming if you developed one, you did have the evidence that you felt was sufficient to make your estimate a better estimate than what management is, and you ask them to fix it and they don't, then we're talking about qualified or adverse. And if it's some sort of, intent to defraud, yeah, then you would probably withdraw. Okay, good. Now let's go ahead though, and let's take a look. And they tell us that accounting estimates are imprecise and can be influenced by management judgment. I mean, they are absolutely influenced by management judgment. These judgments may involve unintentional or intentional management bias. Okay, so when we look at this, we'd say that the estimation uncertainty affects internal risk of material misstatement, including their susceptibility to intentional or unintentional management bias. So when we're looking at this, we're going to want to identify estimates involving relatively low estimation uncertainty. If it's low estimation uncertainty, we're saying that the IR is what? Down, and so the auditor is not going to be as concerned about these sort of things as to those that maybe have a higher estimation uncertainty. Okay, but let's take a look at what they tell us about some of these things that do not have high estimation uncertainty. For example, if the calculations are not complex, I don't know, maybe just some straight line depreciation or something, we're using a life for an asset that they've used before. Okay, and so there's not a whole lot of complex or estimates made and updated because they relate to routine transactions. Okay, if there is some sort of data that is readily available to help with that estimate. Okay, fair value accounting estimates and basically They are applied easily to an asset or a liability. Okay. For example, you could have a situation where the entity holds a listed stock. Well, your fair value estimate there is just simply one number of shares times whatever it was trading at the end of the accounting period. Okay. Fair value accounting estimates in which the accounting is well known. Okay. Those sort of things. So we're not talking about what derivatives here. Okay. They've got some sort of regularly traded stock or something. There's not a whole lot of estimation uncertainty with that. Okay. Now let's go ahead though, and let's flashcard examples where there's a high level of estimation uncertainty. So what's happening now? We've got our inherent risk coming up. And so the auditor is going to have to respond accordingly to that, right? So accounting estimates relating to the outcome of litigation, fair value accounting estimates for derivatives not publicly traded. Okay, again, if they're publicly traded, then you just look to see what the exchanges are saying is the value there. But if it's not publicly traded, that's going to be a little tougher. Or there's some sort of where exceptions of inputs cannot be observed in the marketplace. So you have different level of inputs, okay, and level 1 inputs are directly related to whatever the item is that you're looking at. Level 2 inputs, you maybe through an analogy can kind of get to the fair value. You start getting to level 3 inputs as to how you're determining that fair value. That's probably where you start to have a higher estimation uncertainty because there's no real observable market. And you may need to call in somebody to help you appraise that value, etc. Okay. Now, go ahead and flashcard the examples of accounting estimates with high estimation uncertainty. And then let's come over and let's take a look at the audit procedures, okay? And let's see what the auditor will do now to respond to these risk assessments and if possible, management bias exists. Indicators of management bias do not themselves constitute misstatements, purposes of drawing conclusions on the reasonableness of the individual accounting estimate. But when you see examples of see some of these examples of management bias, then you're going to want to respond accordingly. So changes in accounting estimates, okay, the use of the entity's own assumptions for fair value when they are inconsistent with observable market, the selection of construction or significant assumptions that yield point estimates favorable to management objectives. All their estimates move towards increasing net income, decreasing expenses, increasing revenues, increasing values, etc. Right? And the selection of a point estimate that may indicate a pattern of optimism. Okay, so you start seeing those kind of things, should I say this? Almost you're auditing, Trump Towers or something, because Trump had that problem with one of his entities. He actually got called down by the SEC because what he would do, and this is when they used to have extraordinary items, they got rid of them. Anytime something good happened, it was part of continuing operations. Every time something bad happened, they wanted to push it down into extraordinary. And so they finally got slapped by the SEC. So you see, they don't have extraordinary items anymore, but you see that kind of pattern, then you're going to want to start to say, hey, what's going on here? It looks like there might be some potential for a bias. Okay. Okay, good. Now you come over and for the impact on the risk of material misstatement, okay, how do we calculate risk of material misstatement?
Internal risk times plus control risk.
Inherent risk times control risk. Good. Okay. It's important to say times because none of these factors can be zero. Okay, if any one of these factors is zero, then audit risk would be zero. So I think it's more important to put the times symbol in there, not to be a dork about it, but just to help you remember, none of these factors can ever be zero. okay, because that would make audit risk zero, okay? So let's just take a look, and you can see that estimate with low estimation uncertainty typically have a lower assessed risk of material misstatement, okay? And if you have a lower risk of material misstatement, you'll need less pervasive evidence. Again, I still telling you guys, at the end of the day, you're going to develop an independent estimate, okay? But how intense you get about developing that independent estimate is a function of your assessment of the risk of material misstatement, right? Okay, so you're going to develop an independent estimate. It's just how intense are you going to be about doing that? Let me give you another example. I was on audit looking at the way banks came up with their allowance for loan loss. Congress was concerned about that because, of course, they guarantee the safety and soundness of banks. And there was a concern that maybe banks weren't being quite honest as to how they're evaluating the risk of loan loss for commercial real estate. Because at that point in time, commercial real estate was seen to maybe be taking a dive, and they wanted the GAO to go in and look at that. Now, GAO, the Government Accountability Office branch of Congress, okay, auditing arm of Congress, I don't work there anymore, but you know, the collective we, I guess, the royal we didn't have audit authority over the banks. However, we had audit authority over the Office of the Control of the Currency. And so we asked for their work, and they had a quite elaborate process as to how they looked how homogeneous loans, credit card loans, how those migrated from into, you know, bankruptcy, and how that migration then fed that part of the allowance. Now, according to standard accounting standard, an entity would also have to look at individual loans as well, but we wanted to look at both pieces there. The thing that was funny in that assignment, and well, let me back up, that migration process that the Office of Controller Currency developed was very intense, okay, very you know, using a lot of models and whatnot to determine how these homogeneous loans went into bankruptcy and thus into default, and thus you know, affected what they needed to put in the allowance. So, you know, if it's something where you're having a high level of estimation uncertainty, you would expect that more sophisticated analysis, right? Now, the thing that was, just to finish that story, kind of not quite related to this point, maybe it's more related to the notion of professional skepticism, in that after they did the individual loans and the homogeneous loans, they put what they called additional unallocated. They put it in another amount into the allowance. And when I asked them what that was for, the Office of Control of the Currency didn't really have a good answer. And so finally they said, well, look, would you like to ask the banks that question directly? And so we told the OCC, yeah, you set us up with those meetings, you know, then we'll have the authority to meet with them. So we meet with one of the big banks and Wells Fargo, and in walk these guys, and they're going to tell us how it's done. And they tell us, well, the amount that we're putting in that additional unallocated is for future loans that we haven't made yet. And I'm like, excuse me, guys, but I thought accounting was based on a past transaction or event. How are you putting amounts in allowance for shit that hasn't happened yet? No, what they were trying to do is they were trying to put what? Additional amounts in the allowance and additional amount for the bad debt expense, right? In good times. So later on, if times weren't as good, then they would come back and say, oh, looky, we're kind of over reserved. We don't need to put as much in the allowance for loan loss, so that they could show a nice, steady, smooth pattern for their profits. That's not what the standards allow. So we wrote them up for that. Although I think we kind of, you know, as most of the time, part of the reason I retired, those findings sometimes go off into the ether and nothing changes as a result of it. But that was something that we identified on that. But anyway, I'm going too long here. The point being that the higher the risk of estimation of certainty, the more intense, the more pervasive, the deeper you're going to go in how you develop that estimate. So let's just take a look at that. And if you have accounting estimates that have a high estimation of certainty and you have an indicator of management bias that may lead to an increased assessed risk of material misstatement, and when that increase happens, then that will result in more pervasive, more intense analysis of that estimate. Okay, you can flashcard that. Okay, now, unfortunately, it would have been nice if they just continued on here and said, so develop your own independent estimate. And that's really what you do. Okay, but they're saving that for later on. Okay, we'll accept that. I think they finally get to that in chapter 4. And we're going to move on now to evaluating contingencies and again, assessing risk associated with that. Now, when we come in and we look at contingencies, you can see that contingencies can involve a variety of things, okay, such as pending or threatened litigation, claims and assessment, guarantees of indebtedness, product warranty, income tax dispute. These are all contingencies, meaning that the entity could suffer some sort of loss at some point in time. And if a loss is what? Probable and reasonably estimable, then what? Then GAAP says it needs to be booked into the financial statements. If they can't come up with a reasonable estimate, they have to disclose a range of the possible loss, etc. Right? Okay, all those GAAP rules. So how will we identify contingencies so that we can look to see that it's either been properly accounted for or disclosed? Okay, and notice here, guys, that they expect management to tell us what those potential contingent losses are. So the auditor should ask management, and management is to be truthful in their response to the auditor on that. Okay, and we're going to talk towards the end about the management representation letter. When I say the end, one of the later chapters, we talk about the management representation letter. And in there, we expect them to say, these are the contingencies and we have disclosed those to you. Okay, so we ask management, but that doesn't mean that we don't do other things that you can see here. So flashcard that the auditor should ask management, as well as, okay, let's look at some of these other things, review minutes of stockholders meetings. I think I mentioned this before, I don't know if I did, but I was looking at the the minutes to the board of directors meetings and that sort of thing, and in there all of a sudden whoever was writing up those minutes was trying to be cute, so they kept saying about the case this, the case that, without really describing what the case was. Well, you read that kind of thing, then you're going to go back to management and say, well, you told us about X, Y, and Z, but what is this case? And when I asked that question, oh, we had an employee that claimed some sort of harassment and is suing us. Now, that came, they didn't tell me that until I asked about the case. And so sometimes you'll see things like that. Okay, review correspondence, invoices from lawyers, right? Review contracts, loan guarantees. Review bank confirmation. We're going to talk later about the standard bank confirmation that you send out to the banks, and it is really to address the existence assertion related to cash. So you ask them to confirm the balance in the bank account to give you some evidence around the existence of cash. But then we start looking, and this really starts to be more of a completeness test on that same form. We say, have you, guaranteed any loans to this entity, et cetera? And we start searching for hidden things that maybe they haven't told us about, even though the primary purpose of that bank confirmation is to see if we can get some information, to get evidence to support the existence assertion over cash. But then we start fishing for some of these other things on that same form, and we'll talk about that a little bit later in class. Okay, so not tonight's class, but in the auditing course here. So just go ahead and flashcard those identifying the contingencies. And then let's look at some of the okay. Okay, where am I? I see I've got, I'm looking at the wrong page. Somehow I've got my book in a place that I can't seem to get my eyes wrapped around the right area here. Okay, good. Yeah. Okay, so let's go ahead. Actually, we're probably continuing this list. I can see that's why I'm getting confused. I thought that was I was thinking to myself that was the end of that list, but it continues here. So continue this flashcard over here as identifying contingencies. So we're still in that discussion. If there are long-term purchase commitments, okay, discuss that. If there are long-term leases, etc. Review interim financial statements after year end. Sometimes students are a little confused on that one because it's like it's after year end, but sometimes things that were in motion at the end of the year are being talked about in the interim statements, and interim statements can sometimes get a little ahead of the year end statements in terms of disclosing some of those things. And so you can sit and take a look at some of those interim statements that may be being developed as you're finishing up the year end to help to get your hands around potential litigation. Obtain a client representation letter. Okay, that's the big one, guys. I mean, as I stated, in that letter, we're going to ask them, do you have any contingencies that we need to know about? And they should list them in there. And that representation letter is signed off by management, by the highest levels of the organization, CEO, CFO are signing off on those. Okay. And then send a letter of inquiry to the client's attorney. Now, that's also a big one as well. And we get more into the specifics of that letter a little bit later. Okay. Now, for actual potential litigation. Okay, so now we've identified the litigation. The auditor should obtain evidence related to what is the period involved with this litigation, the degree of a probability of an unfavorable outcome, because if it's unfavorable, we may be expecting to book a loss or at least disclose a range of losses, right? And then the amount of range of potential loss if they're not able to come up with a point estimate on that. What is the range of that? And then the management representation letter should indicate that management has disclosed the independent auditor all relevant, and why that note is down there, I don't know. Because it probably should have been right underneath. Obtain the minute. That's what we're asking them to do. Okay. Okay, good. Related party transactions. Let's talk about that for a second. Is it okay for an entity to engage in transactions with a party that they're related to, a company?
Yes.
Sure, they can do that. But if they do, it has to be what? It has to be properly disclosed as such. Okay. Now, what is the auditor's responsibility? Well, of course, the auditor's responsibility is to determine that if there are related party transactions, what were they, and have they been what? Properly accounted for and disclosed. So since GAAP says that you need to properly account and disclose those, then there's an expectation on the part of the auditor that they will determine whether they're related party transactions and are they properly accounted for and disclosed. Okay, so flashcard the auditor's responsibility there. And just to get a sense as to who related parties are, it could be affiliates, subsidiaries, could be officers of the entity. Sometimes I was looking at a not-for-profit entity that received a certain amount of significant federal financial assistance. It was written in legislation that the GAO would look at that entity periodically. I got stuck, put on that engagement, and one of the things we noted there was that one of the directors had actually contributed to the not-for-profit. Well, that's the kind of thing that you would expect to see as a related party transaction. Sometimes an entity will loan money to its directors, to their officers. That's an example of related party transaction that would be disclosed. Okay. Now you come over and let's take a look at what some of the audit procedures are. We already know that the auditor's responsibility is to do what? Identify related party transactions, make sure that they are properly disclosed. So, do you think that it would be important to know who the entity's related parties are?
Yes.
Yeah, okay. So let's just take a look, and we're going to start with, and let's flashcard, obtain an understanding of the company's process for identifying related parties. Okay. We are going to request that management provide the names of related parties. Now, let me ask you, what do you think you're going to do with that list? You get the list, what are you going to do with it?
Test transactions with the names on those lists.
Yeah, right, Donald. But the way we're going to do that is we will probably be selecting transactions for other audit procedures, but we will provide the staff with the names of the related parties. So when they're doing those other audit procedures, they can at the same time check it against the related party listing and see if that transaction that they're testing for maybe some other purpose was with a related party. So you come down, and I'm just going to draw an arrow down here, okay, and they say review material transactions for related party evidence. Okay, so again, you're looking at these transactions, and you may be doing them for a different audit objective, but then you're going to bounce those against the related party list to see if you discovered a related party transaction. If you discover that, hey, yeah, this is a related party transaction, then you're going to do what? Then you're going to see that it was properly accounted for and disclosed, right? Okay, so flashcard these ones that I'm highlighting, guys. Another step is reviewing filings with SEC, okay, because what happens, entities are supposed to report to the SEC who their directors are, whatnot, who their affiliates are, and that would be another source of getting information about related parties that you could then add to the list of related parties. Okay, now what is the impact on the auditor's report? And if management indicates the financial statements that the transaction was consummated on an arm's length term, and the auditor believes this statement is unsubstantiated, the auditor should express a qualified or adverse opinion. And guys, I'm going to use a word here. I wrote next to that, no shit. I mean, obviously, if they put something in there that they can't substantiate, the auditor's, where is that coming from? Then what? They say qualified or adverse. I guess that means that the standards, the accounting standards, must have tried to help the auditors out here and said, if management puts that statement in their financial statements, they need to provide substantiation of such. And so if they can provide substantiation, then that's why they're saying qualified or adverse. It must be that the standard, the accounting standard, said, well, if you're going to go there, then you better have some way of substantiating that statement. Okay. Sometimes the accounting standards help out the auditor a little bit. Okay. So maybe I shouldn't have said no shit next to that, because that is more of a subtle point. So let me strike that out so that future I don't say that. So, it must be that the standard says that. Sometimes the standard, the accounting standards will help the auditors out. The typical position of the Auditing Standards Board, remember the part of the AICPA that writes the auditing standards, is FASB, go ahead and write the standard that you need to write. We'll figure out a way of auditing it. So when they get a opportunity to comment on a proposed accounting standard. Generally, that's this bend. In fact, sometimes the AICPA doesn't even respond to the FASB's comment period about a particular accounting standard. But sometimes they will come in and say to FASB, you know, you kind of put us behind the 8 ball on this. Can you, you know, give us some requirement of evidence? Another example of this is for the Governmental Accounting Standards Board. They require that entities can use a modified approach to accounting for their infrastructure assets. But in the standard itself, it says that if they choose the modified approach, which means they don't need to depreciate their infrastructure assets, then they have to have a system that keeps track of all their infrastructure assets, and they have to have documentation that they are preserving their infrastructure assets at the level that they have indicated in their financial statements. Well, it is rare for an accounting standard to talk about an accounting system and documentation. So it must have been they're trying to help the auditors there to get a handle on whether or not an entity is providing information that allows them to use the modified approach for accounting for their infrastructure assets. So on occasion, bottom line, you'll see that the accounting standard itself will talk about what the client needs to have to substantiate something. Okay. Now, documentation, the auditor should include the names of all identified related parties, relationships in the audit documentation. So, you know, when you're reviewing a set of work papers, you would look for that. That should be in there. Okay. Who are the related parties? You again are going to provide that list to your audit staff, and then they will go ahead. And that's why it says here, the auditor should discuss the entity's relationships and transaction-related parties with the engagement team and provide the names. That's that listing that we got to management. We provide the names. And then we say the auditor should remain alert. So in other words, what? Remain alert says that while you're doing other procedures, have that list of the related parties sitting there, and that may help you to identify compensating balances, loan guarantees, unusual transactions, transactions on terms that may differ significantly, right? You're not going to back and guarantee loans of strangers. You're not going to sit there and give a favorable interest rate to strangers, right? Okay, non-monetary transactions. So flashcard the things that the auditor is to remain alert for. Okay, and again, you could be looking for these sort of things while you're doing procedures that may be involved in another part of the engagement. Okay, and when the auditor identifies related parties, then what? We're going to want to make sure that the transaction is properly accounted for and disclosed. There, you know, no prohibition against having the related party transactions, but we do want to make sure they're properly accounted for and disclosed. Now, let's say the auditor identifies a related party that management didn't disclose to us. Are we happy?
No,
No. Why? You should know your related parties are. Why am I having to figure this out, right? So now we kind of start getting up into management space. Well, we let everyone on the team know, hey, another related party that should be added to the list. Request management. Get in there and give me all the transactions with this entity. Now you go and dig and you find these. Inquire why you failed, right? Because this is a control weakness now. If it was unintentional, perform appropriate substantive procedures. Now I might go through and do a procedure that is intentionally designed to see if there's any more related party transactions associated with this particular entity, right? Reconsider the risks that other related parties transactions may not have been disclosed. So maybe I'm going to start to want to lower my detection risk by performing additional procedures and evaluate the implications if it appears intentional. Now our fraud risk spidey sense is tingling a little bit, right? Okay. Okay, good. So with all that, let's go ahead and let's take a look at our first class question tonight. See if I can find the poll here. There it is. Okay, guys, we're over 2 minutes here, and part of the reason I'm waiting is that I've got 12 out of 14 responding. I got one person not responding. Okay, I guess that's not too bad. So let's go ahead and let's take a look. And everybody got this right. Okay, we're talking about related party transactions here. Some of the things that they start talking about, everyone got the correct answer here, which is C. Okay, some of the things that they're talking about here are good audit procedures, but not as they relate to related party transactions. For example, inspecting correspondence with lawyers, yeah, for claims and assessments, we probably do that. Batching and counting records for recurring transactions recorded just after the balance sheet date. Now, we did talk about that, but we were looking for things that happened prior to the balance sheet date. If it's after the balance sheet date, we can worry about that next year, right? That's not going to affect this year's audit. Review of confirmation of loans, yeah. Performing analytical procedures for indication of possible financial difficulties. We probably would want to do that in relation to evaluating the entity's ability to continue as a going concern, but I don't see that that's directly related to related party. And obviously C is right there in our wheelhouse of what we would do in this area. Okay, good work. Let's go ahead and let's jump ourselves to the next module. And they start talking generally about evidence here. I find it a little annoying because they kind of slip into a discussion of substantive evidence. Substantive evidence is used to decrease our detection risk, right? Okay, but that's not the only audit evidence that we need. We also need audit evidence to what? To support our understanding and assessment of the risk of material misstatement, and then how did we respond through these substantive procedures? Well, that process of obtaining the information for the risk assessment is audit evidence, okay? And then particularly if we have to test the operating effectiveness of the controls, remember we do that if we assess the risk of material misstatement at less than the maximum, then we need to have evidence as to that operating effectiveness. Okay, so it gets a little annoying that they kind of slip into the substantive and they kind of make you feel like that's where they are. And then every now and then they kind of throw in something about the internal control evidence. So I just want you to keep in mind as we go through this, it's both. It's evidence as to the internal control risk assessment. It's evidence as to the amounts that are included in the financial statements. Yes, substantive procedures. Okay, so let's just go ahead and let's take a look. And they start talking about different types of evidence here, guys. The accounting records include books of original entry and the supporting records. So books of original entry, journals, ledgers, and what? Invoices and whatnot that would support that. Okay, now corroborating evidence includes things like minutes, confirmation, information from specialists, inquiry, inspection, these different things that would corroborate the things that we're seeing in the accounting records. Okay, now evidence in an electronic form. Remember, we talked about the disappearing audit trail. So we need to make sure that if information is not going to be available later on, that we do some procedure. Maybe we do an embedded audit module. When we talked about that computer assisted audit technique that'll save off certain transactions, or we ask them to save certain information for us that we think would be relevant, or maybe we're doing our audit procedures throughout the year while that evidence is still available. Maybe we're going in quarterly before they purge their systems or something, but you need to keep that in mind, that evidence is not indefinitely available in a IT type environment. Okay. Now, the evidence is supposed to be the reasonable basis for our opinion, and I think it's worth remembering that the auditor is looking for what? Pervasive rather than conclusive evidence. Okay, you are not going to be able to say in your audit opinion the financial statements are free of material misstatement. That's an absolute assurance. It is what? Reasonable assurance that we're providing, and we want the evidence to be persuasive towards that opinion. Okay, now cost alone is not an appropriate reason for omitting a particular procedure for which there is no alternative. Okay, so if you are sitting there and you're like, well, that's a costly procedure, I don't want to do it, but it's the only way that you can get the evidence that the standard is contemplating, cost is not sufficient answer. So that means you're going to need to do your homework to make sure that your fees and whatnot are what's structured around what you need to do to successfully complete the audit. That's why sometimes you read in the CPA letter, which is a document that's published by the California State Board of Accountancy, you'll read about a CPA that got themselves in trouble because they did an audit without having the appropriate technical competence to successfully complete that audit. The state boards of accountancy have no sense of humor for you taking off an airplane and not being able to land it. Okay, so you start that for the audit, you better know what you need to do to complete it, and you find yourself, oh geez, I didn't realize it was going to cost me this much. Well, too effing bad. You're going to have to do that procedure. You may need to take a loss on that engagement if you kind of underestimated what you're getting yourself into. Okay, now you come over and the sufficiency of the audit evidence is subject to the auditor's professional judgment. Okay, now when we look at that, okay, we're going to look at the quality of the evidence and the quantity of the evidence. Okay, so you take a look, and the auditor's decision regarding the sufficiency of evidence has to deal with the risk of material misstatement. Greater risk implies what? Implies more evidence. Well, what are we saying? What risk are we talking about here? The risk of material misstatement. So RMM is up. What needs to be down?
Detection risk,
Good. Detection risk needs to be down. What's got to be up then?
substantive procedures,
Substantive testing. Good. When we say substantive testing, Michael, since you're out here on a limb now, what are we talking about? How do we look at our substantive testing?
Details, I think.
Well, there's two types of substantive testing. Yes, test
The
details.
nature, timing, and extent of the audit.
Good. We're looking at, I'm not sure who said that. Was that Roy? We're
Yeah.
talking about what? Nature, extent, and timing, aren't we? So if that risk of material misstatement is going up, nature, more effective procedure like external evidence, extent, larger sample sizes, timing, we're probably doing what? Year-end testing rather than interim testing. So when they say it involves more, I'm going to use improper English and say here what? More better evidence. We're looking for more better evidence. Okay. So when we start talking about what? We start talking about quality of evidence, then we're probably talking about what? We're talking probably more about nature and what? Timing. When we talk about the quality, okay, when we start to talk about, you know, more, the notion of more, now we're probably talking maybe more about what? Extent, whereas better is going to point to nature and timing. Okay, okay, now if we start to get better evidence, then we may not need what? As much evidence. So there can also be trade-offs here between what? Well, I'm getting a higher quality evidence, so that can substitute some of the extent. Okay. All right. So the auditor is kind of, you know, walking this back and forth to get the sufficient evidence that is going to be what? That is going to be pervasive, or excuse me, persuasive. Okay. And you can't sit there and say, well, the evidence I really need is this, but it costs too much, so I'm not going to do it. No, that's not okay either. Okay. Now you come over and you take a look, and what they do down here is they give us a hierarchy of evidence, okay, a actual list as to what evidence is better than others, okay, and when we look at evidence, okay, don't forget that we are going to relate that evidence to what? We look for evidence that helps to support the assertion, don't we? Okay. Now, as we look at the reliability of these evidence as it relates to the assertion, they give us a hierarchical list, okay? And let's just go over to the passkey. Okay, let's go over to the passkey. I want to jump all the way down to the passkey because they finally gave us a decent passkey, and that the auditor's direct personal knowledge is the best evidence. So if you sit there and they tell you that they have equipment, and you go and you see that piece of equipment, that's your best evidence, at least for the existence assertion, at least for the existence assertion. Now, for the rights and obligation assertion, you would probably want another procedure which would allow you to look and see a document that says that they have ownership, right? But at least for the existence, seeing that thing, the direct personal knowledge. Recalculation is direct personal knowledge. If you went and you recalculated something, that's your best evidence, okay? Now, the second best evidence is external evidence. Now, when we look at external evidence, what I want you to do is that's the next on the hierarchy, but let's go up and see what they tell us, a little bit more information that you should include on the flashcard about external evidence. There are two types. External evidence sent directly to the auditor, for example, e.g. confirmations. And we're going to talk about those here generally in a second. But confirmations happen when the auditor confirms directly, say with the client's customer, an amount that's owed on an account receivable or something, right? Evidence received from outside, but held by the client, and the client turns around and gives it to you. For example, bank statement. Okay, so on your flashcard that I'm asking you to make here, regarding, the evidence in the hierarchy, next on the list is external evidence, internal evidence. And why don't you put next to that internal evidence, put documentary. Internal evidence, because then they put number 4, the least persuasive. Least persuasive is going to be oral evidence, and you really can't completely support anything in the financial statements just off of oral evidence. You will always need to combine that with one of the other types of evidence here. Okay, so again, depending on how I'm trying to lower that detection risk, I will try to get the appropriate mix of my sample size, but also the quality of the evidence here. Okay, now this is the hierarchy of audit evidence related to what? This is related to substantive procedures. And this is my point, guys, where they don't do a real good job kind of considering, the book doesn't do the greatest job here, considering, well, we also need evidence for the internal control, don't we? Okay, and I gave you, though, a flashcard that was similar to what we're doing here as to the hierarchy of evidence for my control testing. So I'm just going to review that with you here. And remember, I had made a mistake when I put this little graphic together, and that I didn't have them in the appropriate order. Okay, so what happens? Most persuasive evidence for the control test is reperformance of the control. Remember, we had that little example on the sales chart where we actually made a few of the calls to the client's customer to confirm their satisfaction with goods. That's a real nice way of getting the evidence, like direct personal knowledge as to the operating effectiveness of that control. Then what? Inspection of documents, right? That's why we wanted those control sheets that I kind of made up as an example in the jewelry shop example, where they signed off that they had followed the procedures to take inventory on a daily basis. So we can go back and look at that. It helps us with operating effectiveness. Observation, okay? Some controls, you simply just have to observe them at a point in time, okay? Like the use of cameras. Okay, sometimes though you look and they have cameras observing what's going on, and you see the cameras and you say, gee, can we look at some of the data from those? And they tell you, oh, well, they're not recording anywhere. We just have them up as a deterrent, right? So, at least you understand what they're using them as a deterrent anyway. Inquiry, helps more with what? And that's like oral evidence in the other list. Helps obviously with obtaining an understanding, maybe getting some evidence as to operating effectiveness as you do a walkthrough, but in and of itself, it won't help you reduce the control risk or corroborate anyway the lower assessed level of control risk, because it's not going to give you much evidence as to operating effectiveness. Okay, but again, the point right now, that's more of a review, being that, hey, when they're giving us this list, they're talking about more evidence as it relates to substantive testing. The little triangle over there, the pyramid over there, is more in line with the notion of control testing, because you do have to have a control risk assessment, because you do have to have evidence for both. Okay. Now, when we look at the assertions, again, we relate the assertion. When we look at the evidence, we relate the evidence to the assertions, right? And this is worth flashcarding, because this is something I've seen that they like to trick you with on the exam. So it's not often that I have you flashcard a specific example about something, but existence is a good audit procedure to line up with the what? To line up with the existence assertion, confirmation, excuse me. Confirmation is a good audit procedure to line up with the existence assertion. So the client's customer says, yes, I owe $25,000. Now that confuses candidate because you say, oh, okay, well, that's also helping with the valuation assertion. No, the client may be sitting there, the client's customer may be sitting there saying, yeah, I owe 25,000. Good luck collecting it from me because I'm filing for bankruptcy. I can't pay that. So to get to the valuation assertion, okay, is valuation the amount that I think I'm going to collect on a receivable? Is that an estimate? The amount that I think, that's an estimate, right? Because they're going to have to figure out, estimate what they can't collect. And then they're going to have to put an amount in the allowance for doubtful accounts. Well, that's the evaluation assertion. How do you audit accounting estimates?
Recalculate.
Recalculate. Excellent. Develop your own independent estimate. Recalculate. So for the valuation assertion over account receivable, yeah, for existence, I'll send a confirmation. For valuation, I'll probably recalculate, and depending on how risky and how much management bias I think there may be in that estimate, the more intense my recalculation is going to be, right? I might do some sort of migration analysis of those receivables. Now, when you look again, guys, and I've shown you this thing 52 times now, but I'm going to show it to you again, okay? And that is this sales chart thing, okay, that I had given you as an example. And the reason I'm putting it up right now is, don't forget, you are not just responding with these audit procedures, these substantive procedures in a vacuum, okay? It is after there has been an assessment of the risk and material misstatement, an evaluation of the internal controls, and then obtaining evidence as to the operating effectiveness of the controls. And you look for controls that prevent or detect the misstatement and that particular assertion. So it starts with the assertion. You look for the controls that prevent or detect. If you feel those controls have operating effectiveness, you get evidence to support that operating effectiveness. And then you move to the timing, extent, and nature of your substantive procedures to lower your detection risk. So you need to think of it as a process, even though as we're reviewing this information here in the Becker book, we're kind of chopping it up and throwing it all over the place. And sometimes we weave in and out of talking about, you know, substantive evidence versus control evidence. Okay. Okay, good. Now you come over and evaluating the appropriateness of evidence, okay? And let's take a look here. And let's look at this notion of revising the assessment of risk and material misstatement, okay? And notice they tell us that results of tested controls may indicate that the controls are not functioning effectively. In other words, we test the controls, and as a result of the test of controls, we determine the controls do not have operating effectiveness, which will result what? In a higher assessment of the risk and material misstatement. And we're going to respond to that by either looking for other controls that will mitigate the weakness of this control, or probably more likely result in us reassessing our risk and material misstatement and responding to that by trying to lower our detection risk by altering the nature, extent, and timing of our substantive procedure. Okay, so you must have evidence that supports the operating effectiveness of the controls. And then material misstatement discovered while performing substantive procedures that were not detected by the entity's control are considered a significant deficiency or material weakness that will cause the auditor to change the judgment regarding the effectiveness control. So now you start to find misstatements, and you're saying, well, gee, I thought these controls had operating effectiveness, but look at all these errors I'm finding. Maybe I need to what? Reassess that risk and material misstatement and add more substantive testing as a result. Okay. Also, if you're dealing with a public company, that has the potential of affecting the auditor's opinion on the internal control, since you're expected to provide that, right? Okay, and we'll talk more about that in a later chapter, I think chapter 5. Okay, good. So with all that basic discussion of evidence, let's go ahead and let's take a look at this multiple choice question. Once we finish this up, we'll have time for our break. Oops. Don't want that. Okay, good. Let's go ahead and let's take a look at this one. And just about, well, everyone got this right 100%. Then pretty straightforward question. We're asking which is the most persuasive, auditor's direct personal knowledge, external evidence, two categories, those directly, those first held by the client and then given to the auditor. And what then we have the internal evidence, documentary, and we have oral evidence, right? Okay, so when we look at this list here, and again, pretty much everybody got that right. Everybody got that right. The answer is C. But when we look at the list, pre-numbered client purchase orders, well, that's internal. Client worksheets, internal. Client representation letter, that's, well, we have to get that. That is internal. Okay, and the only thing that was external, though held first by the client, is the bank statements. Bank confirmation comes directly to the auditor, would be better, but they didn't give us that option. Okay, good. Let's go ahead. Let's take the break before we jump into module 6. I'm showing that we're about at 6:30 now, so we'll go ahead, take a 10-minute break, reconvene here at 6:40. I'm going to pause the recording. If I forget, please remind me to restart it. Okay, so when we look at our substantive procedures, we have two types. We have test of details. And we have substantive analytics. And I'm just going to call those ARP. I should probably just call them analytical procedures, but I don't want it to be mistaken with accounts payable. So I'm going to put the R letter in there, analytical review procedures. Okay. Now, what happens? With a test of details, okay, there are two sort of approaches that you can use with a test of details, okay? And so you can break the test of details and perform them on ending balances or the details of transactions or a combination of the two. So if an account has a high turnover rate with transactions occurring throughout the year, then you're going to be probably better off testing the ending balance. So what happens? Client has a lot of sales are generating accounts receivable. You probably would do a confirmation or at least over the existence assertion, right, for the accounts receivable confirmation at year-end balance. Now, if you have a situation in which there are not a lot of transactions affecting an account, for example, we're talking about land or treasury stock transactions, then you could probably go ahead and just test the transactions that hit that account during the year because there's not a lot. Okay, so two different approaches, both perfectly acceptable. And again, you don't have to pick one over the other. You can do a combination. Okay, so one approach can be used exclusively, probably more likely that there would be a combination of the two depending on the nature of the account, as we just talked about. Okay, now we come down and we talk about analytical procedures. Okay, and as we have indicated in another section, analytical procedures, well, first off, involve plausible relationships and amounts expected by the auditor. Okay, it's got to be something reasonable. Okay, and it can include both financial and non-financial data. Okay, so financial data. I want to determine if the entity has properly reported its interest expense. Do you think it would be reasonable to understand the amount of debt that my client has and then do an analytic to see if the interest expense is reasonable based on the amount of debt?
Yes.
Yeah, I get a comfort level with that debt, so I could audit related accounts simultaneously where I'm sitting there and I'm getting comfortable with the debt. Now I'm going to go ahead and I'm going to get comfortable with the interest expense. And I can set up a nice analytic that helps me to get comfortable with the interest expense based on the debt, right? Good. That's financial data. Non-financial. Let's say I'm auditing a laundromat and I'm trying to get a handle on the washing machine revenue. And I'm looking at that and I'm saying, well, gee, you know, I'd like to do a test of details. That's more likely going to be the case. And I'll do test of details to get my audit evidence over assertion. But for washing machine revenue, that's pretty tough. So it's pretty much people dropping coins or whatever into a washing machine, right? Into the laundromat. So maybe I'll say, well, look, I can get the substantive evidence I need by looking at the water bill. And if they use more water, there should be more washing machine revenue, less water, less washing machine revenue, right? Okay, so that might be an example there as to how you would do you know, non-financial data, but you can use both financial and non-financial. Now, the auditor must, what does must mean? I mean, you got to do it. Must use analytical procedures for planning and the overall review phase. Planning at the beginning, overall review phase at the end. You got to do that, okay? But you may also decide to use analytical procedures as a substantive test, okay? So flashcard, well, actually, I'm going to have you flashcard on the next page, but let's talk about this here for a second. The standards allow for some of this up here because they know that some assertions may not lend themselves to a test of detail, or if my risk of material misstatement for a particular assertion is particularly low, okay, do some analytics. The evidence is not, from a nature standpoint, as valuable as a test of details, but maybe you can afford a little less reliable evidence, again, nature, because you have a lower assessed risk of material misstatement, right? Okay, now, so they give us that option, but just go over to the next page in flashcard. And basically the part I want you to do is this part right here on the flashcard, which is when are we required during the beginning and the end of the audit, and then what? We're not required, but we may want to do substantive analytic procedures. I would think these days most audit organizations would combine some amount of analytical review procedure with the test of details. You know, because the data analytics software is getting more and more powerful, a lot of times things that we maybe would have lent to a substantive analytical procedure before, now we just go ahead and do a test of details on it because you can do 100% testing in a swoop of a mouse here. So it really kind of depends. Okay. Now, what we're going to do is we're going to come over and we're going to look at how we would use substantive analytics. Okay. But let's just go ahead and stop and let's flesh out a little bit more of that washing machine revenue example I gave you. So we come in and we think that the water bill would be a good indicator of what the washing machine revenue should be. So we look and we look at the water bill, and the water bill tells us that the client used 15,000 gallons of water. Okay, now let's say, and I don't know, guys, you know how this works these days, but let's say every load of laundry, each load requires, I'll make it, each load requires 2 gallons of water. I don't know. Who knows? Okay, so if it's 15,000 gallons of water and each load requires 2 gallons, that means that if I'm doing my math right, that we're thinking this entity had what? Had 7,500 loads during the year. And let's say they charge their clients, I don't know what they charge for a load of laundry these days. Wow, is $5 reasonable? I don't know. Anybody know? I don't know. Let's say it's $3 a load. I don't know. Okay. So what is the auditor's estimate of washing machine revenue? Math help, please.
$22,500.
22,500, you say, Michael?
Yes.
Okay, good. Now, that's what the auditor's estimate is, but they're not going to go in and kill management if it's not exactly 22,500. Okay, so what they would do is they would set a range. Okay, now in the GAO, when we did analytical audit procedures, analytical review procedures, we would allow for a plus or minus 20%. That's not written in the standard. That is written into the GAO's audit manual. So if we're looking at plus or minus 20% onto 22,500, what do we got here?
4,500.
No, couldn't be. That'd be too much. You sure? 22,500. You know, I get so tired of these goddamn spammers that every time you pick up your phone, they start to call you because they know that you got your phone in your hand and you're doing something else, and they figure this is a great opportunity to catch you off guard. So 22,500 times 0.2 is 4,500. Is that when you 4,500 plus 22,500 would put us at 27,000 at the top end?
And then the lower end is like 18.
And at the lower end, 22,500 times 0.2 is 4,500 plus 22, minus, what is it? 18, you say?
Yeah, it's 18.
Yeah.
18,000.
Okay, good. So we come up with a range, okay? Now, of what we think the revenue should be. Now, let's say when they look at the revenue and they report the revenue to us, when we look at what the revenue is reported on the financial statement, it's say 25,000. Is the auditor happy?
Yep.
Yes.
Yeah, we're sitting there saying, okay, that turned out the way we expected. Okay, that's the happy auditor. Now, what happens, okay, if when we look at this, it's 29,000? Now what? Happy or sad auditor?
Sad.
Well, I have his mouth open, not a shocked mouth, but it's an inquiring mouth. Because it's saying, you know, we did this analytical procedure. Expectation using the water bill was that it would be around 27,000. You're up here at 29. What's going on? And the client says, wait a minute, you used the water bill. Did you use the city water bill? And we say, yeah. So they say, oh, well, we have some clients that don't want their laundry washed by city water. They want purified water from the mountains. We have that shipped in, and we charge $5 per load for that. Okay. Oh, well, we didn't know that, right? So what do? We go ahead and we maybe now turn a little more to test of details. Well, can I please see the trucking water bills? I want to see how much they charge for that water, how many gallons, etc. We bring that in at the $5. It explains the difference. Now we're happy, okay? But we're going to have to do something to address, I should say, that difference, okay? All right, so that's where we're going with this. So with that, you know, little example in mind now, let's go ahead and let's go through the procedures for a substantive analytic, and let's flashcard at a high level these procedures. So determine that the analytical procedure is suitable for testing the assertion. Yeah, I think water bill, unless you can tell me a way of washing laundry without water, I think that's pretty reasonable, right? Evaluate the reliability of the data. Well, okay, city water bill is external evidence, isn't it? Coming from a government entity. So that's a pretty reliable source. Develop the expectation. And when I develop the expectation, I can use what? Financial information for comparable periods, budget and forecast. I can use non-financial information such as the water bill, right? Okay. Now coming down, again, we're flashcarding these. Okay, perform the analytical procedure and compare the results of the analytical procedure with the expectations, which we did. Okay. Now, we need to investigate significant differences by inquiring the management, and then what? Performing other audit procedures as necessary. That's what we did, didn't we? We inquired, they gave us something, and we performed the alternative procedures and saw what we came up with. Okay. Now, you come over and they say that analytical procedures are most effective for assertions with potential misstatements are not apparent. If from a detailed look at the evidence, or when such evidence is not available, which is what I was sort of contemplating with that washing machine example. But that first part, the green part there, if they're telling us misstatements are not apparent, what is that telling us about our risk assessment? The statements,
High.
huh?
A risk would be high.
Misstatements are not apparent. Potential misstatements are not apparent. You think you have a high risk? Of what risk are you talking about?
That would be inherent risk, right?
Well, if potential misstatements are not apparent,
It'd be a
then
low risk.
my inherent risk is probably down, right? Right? Or if I have a higher inherent risk, maybe I got some nice controls. So my RMM must be down, right? If RMM is down, what can be up?
Detection risk.
Detection risk, well, what can be down then? Come on, guys, I don't
Substantive
want to have to
testing.
wait for the answer. This should be like a reflex on you now. We talked about
Substantive testing.
substantive testing, good. So if substantive testing is down, what they're saying to us is what? Well, if substantive testing is down, maybe you can afford a little bit more of those substantive analytics and you don't have to do as much tested details, right? Or if the evidence isn't available, what are you going to do? Then you're going to have to go ahead and turn to a more substantive analytic approach. Okay? Okay, good. Now, when we look at this, we are looking at plausible, practical relationships. Okay, so in order for the analytical procedure to work well, it has to be a clear understanding of the relationship amongst data. Okay, water bill, washing machine revenue, debt, interest expense. It can't be stuff like, well, gee, how many trips did they take or something it's got to be something that you can have a nice, the less static between the data you're using, the analytic, and the thing that you're looking at, the better. Okay, more plausible relationships. Okay. Now, so you can go ahead and take a look. You need to look in order to provide an appropriate level of assurance. Analytical procedures should be based on predictable relationships. More predictable relationships are provided in a general stable rather than a dynamic, and involve what? Involve both income statement and balance sheet accounts. Okay, that's why I'm giving that example of the debt. Okay, so go ahead and flashcard that. And then the other thing you need to understand is the reliability for the data that's used in the analytic. Okay, so external water bill is better, generated under more effective internal controls. I was on a assignment looking at the Federal Reserve banks providing a service to the federal government for the issuance of treasury debt. And I wanted to do some analytical procedures. So I asked them about internal controls over certain non-financial operating data that I was going to be using. And they told me that's outside the scope of your audit. I'm like, no, it's not. If I'm going to use this data in analytic, I need to understand the controls associated with that data that I'm going to use in my analytic. That's outside the scope of your audit. And if you ask for that information, we're going to bring a security guard in here to sit with you while you look at it. And I'm like, go ahead. It ain't the first time I've had cops want to sit with me for some reason. You want to come and sit with me? Have them come on in. In fact, I'll buy them some coffee. We can sit here all night. So they gave up on this idea of having the security guard come sit with me. They finally gave me the data because I wanted to use that data in the analytic. If the data you use in the analytic is garbage, garbage in, garbage out, right? So you'd have to get some sense of the controls over the data you're using in the analytic. Okay, all right, good. Now we come over and methods used to develop. And why don't you go ahead, guys, and flashcard some of these methods that would be used for analytical procedures, such as trend analysis, longitudinal analysis, right? Ratio analysis, non-statistical predictive modeling, regression analysis, and regression analysis is probably a pretty reliable tool. So why don't you go ahead and flashcard that. We talk about regression analysis more in the BEC course, but regression analysis basically tries to look at the dependent variable as it relates to an independent variable. Independent variable in our little example is what? Gallons of water from the water bill. Okay, and based on that, we came up with what the the dependent variable would be, which is washing machine revenue. Now, what happens? We may see a series of observations as it relates to water use and washing machine revenue. And if you look at that, that's not quite linear, is it? Okay, but what regression analysis would do is say, well, we're going to statistically fit a line to that pattern of observations that you have, and we will give you some amount of information that will allow you to assume that that relationship meets something like this, a y equals mx plus b type of a thing, a linear relationship. And if the parameters of the regression analysis tell you that that's okay, then they're saying to you, okay, you can predict washing machine revenue based on the use of water. And we would use that to come up with that point estimate and then compare that to what they actually have recorded. Okay. Okay, and we're going to talk more about analytical procedures a little bit later in the actually in this chapter, probably next time, not tonight. Okay, now we have to document what happened with the analytical procedures. Okay, let's flashcard what needs to be documented. I ask you to flashcard that because there are questions that say what needs to be documented. And then it is often a nice review of what we just talked about. So what was the auditor's expectation? Washing machine revenue should be whatever we said, 20-something thousand, whatever. Factors considered, the water bill, the results. Well, it was this amount and that was okay. Was this amount higher and that wasn't okay? So we did additional audit procedures. We got the trucking water bills and the result was that it explained the difference. Okay. Okay, good. Question. Now, analytical procedures, as we've seen, it is required that you do them at a high level at the end of the engagement, and flashcard that that's generally done by a manager or partner. Okay. Okay, good. And we're trying to determine whether additional audit procedures need to be performed if something falls outside of the expectations at the end. The problem here, you're like, well, why do we have to do them at the end if we've done all this tested details and whatnot? Well, unfortunately, financial statements are not just sitting there waiting for us to audit them and say, nothing else is going to happen to us while you're auditing them. They're making adjustments and things are happening while we're auditing. And so once before we could finally go out at the end, one more set of analytics to make sure something didn't sneak in on us there at the end, right? Okay. Okay, good. Now, directional testing. Okay. And what happens? Directional testing is telling you whether you should start from outside the financial statement or start from the financial statement. Okay. Now, if you start from the financial statement and you go to supporting documents, let's say, evidence would be more appropriate term to use there, but let's just call it supporting documents. Okay. What assertion do you think that is?
Existence.
Good. That is the existence assertion. Excellent. Okay. Because what happens? You look in the financial statements, you're looking at the financial statement. Okay. Say this piece of paper is the financial statement. It says on there, one lamp. Well, they're saying they have one lamp. Do they really? So what do? I go and I find the lamp. Okay, there's a lamp sitting there. Okay, I go and I find that lamp. Hear that? That's a lamp. There it is. Okay, so I confirmed the existence of that lamp by what? Here it is, and I went and saw it, right? Okay, now if I start, let's say, with supporting docs, and evidence would be a better word. And then I take it to the financial statements. What assertion is that, do you think? I need to draw a picture of the document there. What assertion is that?
Completeness.
Good, excellent, that's completeness. So now I'm sitting there and, I pick an item, my little puppies and kittens calendar here that somebody gave me, okay? So I'm sitting here and I have my calendar and I want to say, well, did they include this in the financial statements? So what do? I see it here and I come back to the financial statements and it says, oh yeah, one puppies and kittens calendar, they included it, right? It was here and they included it, okay? Now, you need to get good at auditing these assertions. Now, what I don't like about this picture is notice I gave you this whole discussion and never did I mention the words that they call here vouch and trace. They're telling you here that you vouch for existence, meaning you start with the financial statements and you go and find the supporting documentation, supporting evidence. Trace means that you find the information outside of the financial statements and you take it back to the financial, the way I just described with the puppies and kittens calendar. But the problem with memorizing vouch and trace as words, the examiners are not consistent in how they use those words. So you could be setting yourself up for confusion and failure on the exam if you just memorize the words. So I need you to understand the process. If I'm trying to figure out, is something in the financial statements actually existing? I start with that item in the financial statements and I go and I find it. If I'm sitting there and I want to determine if something is properly included, I start with whatever the supporting evidence is, in this case, the calendar, and I go and I do what? I make sure it's listed properly in the financial statements. Okay? It's all about the assertions as we start to select the appropriate audit procedures. Okay? Now, you come over and they start talking about confirmation. Okay, now external confirmation, okay, and I don't know if they say that here, is the classic existence test. Okay, it's the classic existence test. What do I mean by that? Well, think about it. With a confirmation, say confirmation of account receivable, you select a particular client's customer and you send a letter to that customer saying, do you owe $5,000, whatever it is. So that's starting with the client's customer's name in their subsidiary ledger. So you're starting with the financial statement and you're calling outside and saying, hello, is there anybody out there, right? And if they come back and say, yes, I owe 5,000, you have supported the existence assertion, haven't you? Okay, so confirmation is classic for existence. Okay, now external confirmation is the form of evidence when we go directly to that third party. And the response could be electronic or in paper form. Okay, note that an oral response does not meet the definition of external confirmation. Now, sometimes students have trouble with that because sometimes you send out a confirmation and the client's customer doesn't respond. And so you call them and you kind of, because sometimes clients' customers are confused as to what it is they should do and they just ignore it. So you call them and you walk them through what you want and they say, oh yeah, okay, oh, I see, yeah, I got it. Well, that's okay. But they're going to have to follow that up. You'll say, hey, can you please send me an email back or send me the mail and the confirmation or whatever process you're using to obtain those. But it's not just based on your conversation. You can't write down, yeah, they said yes, so it's okay. Something's going to have to come directly from that, in other words. Okay. Okay, good. Now you come over. And so why don't you go ahead and flashcard that. Okay. That's all I want to look at there. Okay, now we come over and confirmation could be positive or negative. Now, if it is positive, that means that you expect a response from the client's customer stating whether or not they agree or disagree with the account balance, whatever it is. Okay, so go ahead and flashcard that. Negative confirmation, you ask the party, the confirming party, to only contact you if they disagree. Okay, now what's happening? If you're asking them to only, which of these do you think gives you better evidence?
Positive.
The positive gives you better, doesn't it? Okay, so we must be saying that our RMM must be what? Must be down. Our detection risk is up. What's if my detection risk is up? What can be down?
Substantive testing.
Beautiful. That's the kind of response I'm looking for. I'm proud of you. More importantly, the ghost of Newt Becker is proud of you. Who's Newt Becker? Newt Becker was the guy who invented CPA review. Before Newt Becker, everyone was on their own when it came to passing the CPA exam. But Newt Becker worked with PW at that time, Price Waterhouse, and I guess talk around the campfire was, if you want to pass the CPA exam, you got to go talk to this kid Newt. So they took him offline, and all he did was train PW folks how to pass the exam. Well, some partners looked at that and said, you know, this kid's got some talent. We should go ahead and help him to get into business. So they kind of funded him a little bit, and he started CPA review. Now, these days, you got other review courses, but everyone leverages off of what Newt Becker did, okay? So the ghost, he's no longer with us. That was like 1955 when he was doing all that, before I was born, but the ghost of Newt Becker is proud of you, okay? And I'm proud of you. Okay, now, substantive testing is down, and what do you think? Which is down here? Is it nature, extent, or timing?
Extent.
Nah, I don't think so. Extent really starts to talk more about the size of your sample and a test of details. This is what? Nature, because you're sitting there and you're saying, hey, only respond to me if you don't agree. And in most cases, people might just throw that in the garbage. But if you had good controls, then maybe you could accept that. Okay. Okay, good. Now you come over and we take a look, and the auditor is the one that controls those confirmations. I was on an assignment one time where we were doing confirmation, and I probably should have given the staff a little more guidance, because she agreed with the entity that we were looking at that the confirmations could be sent back to the entity. So she came to me and she says, yeah, you know, guess what? They're going to be so nice to us. They said that they would handle the confirmations and that they could come back to them. So I said, no, the confirmation controlled by the auditor. It comes directly back to the auditor. And then I sat down with that agency, you know, the people we were working with, and said, do not do something like that again. You know better. This is not your first rodeo. If I send staff in there, don't sit there and try to take advantage of their naivety, their lack of, you know, a lot of experience, or we're going to start to have a problem. Understood? And they're like, okay. And of course, then later on, I get comments. John was very mean with us, and he wasn't very professional. Well, you know, you weren't professional when you started that kind of nonsense. So anyway, okay. All right, good. Now you come over and you take a look, and management's refusal to allow. Now you see the phrase management's refusal and you think, uh-oh, here we go. Disclaimer, withdraw. No, if management refuses to the procedure, the auditor should evaluate the validity of the reasonableness of management's refusal. Let's say management says to us, you know, you did the confirmation last year, and we had several clients that thought we had done something wrong and started to evaluate their relationship with us. Is there anything else you can do besides that confirmation? Because it really kind of caused us some trouble. Okay, and so we step back and we say, okay, yeah, you know what we'll do, instead of confirming an account receivable, we'll do a subsequent collection test. So what we'll do is we'll look at collections that are made, say, early in the next year while we're still completing the audit. So we're doing the audit of the 2022 financial statements, but we could look to see what collections that occurred in 2023. If an account receivable is an asset, that means it has future economic benefit, and great evidence that you had future economic benefits that you collected cash in what ended up being the future, right? So you can perform an alternative procedure, but you know, the auditor needs to consider that and then go ahead and perform alternative procedures. But you really want to consider, you know, are they reasonable in what they're asking you to do? Okay, but it is okay under some circumstances not to confirm. Okay, now an electronic confirmation system is fine. Okay, and you may even want to have some sort of you know, electronic or secure upload. Okay, so what you do is you give the person, the confirming party, you give them a unique identifier and a password that's specific to them, and then they upload specifically the information that you're looking for. Okay, so that could be something. Now, you know, of course, you want to consider the fact that that there may be some sort of shenanigans going on where maybe they've gotten into some sort of relationship with the client and they give the client that information, right? So, you know, you want to be a little bit careful with that, but you're gonna have to be able to trust the client. Each confirmation non-response should be followed up on, perform alternative procedures. An oral response alone is not enough. So if you have to hound them and they tell you finally, okay, thank you for helping me understand what I'm supposed to do. Yeah, okay, I'm going to go ahead and, you know, send you now some sort of written response. So it's got to be written response. And we did sit there and flashcard that earlier. Okay, now all expectations should be investigated to determine whether they're indicative of material misstatement. Okay, now they say exceptions resulting from timing or measurement differences or clerical errors. Okay, and you can flashcard this, but when we say clerical errors, whose clerical errors? The client's clerical errors or the confirming party's clerical errors?
Confirming party?
Yeah, the confirming party, if they're making some mistake, a clerical error, okay, then yeah, okay, you know, we don't blame the client for that. You know, if there's a reason for a difference, and we would have to get to the bottom of that. The client's clerical error is a misstatement. It may not be intentional. So, well, it's not intentional if we call it an error. Okay. Okay, good. Now, on the next page, we revisit confirmations. Okay, and remember, guys, that we put our not confirmations, excuse me. That's it for confirmations. We call these stupid things assertions. Okay, so we're talking about assertions here, and remember, we categorized our assertions into 3 broad categories: account balances. Okay, and account balances are basically transactions from all years. So if we bought a piece of equipment a couple of years ago and we still have it, we would expect that that equipment, and the client still has it, we would expect that that equipment would still be reflected in the financial statements, right? Okay. When we talk about transactions and events are generally looking at what? Looking at the current year. So we're probably looking more at what? At journals, okay? Whereas when we're looking at what? At account balances, we're probably looking at what? Ledgers more. Okay, because those transactions could happen in any year. Current year, we're looking more at journals. And then when we come to, where's presentation and disclosure? We don't have that as a category anymore? Okay, so I guess we only have two categories, good. They don't have presentation and disclosure as a, because I guess they put related disclosures next to all these now. Okay, interesting. Okay, so related disclosures are just listed here now with the different types of transactions. It makes our job as CPA candidates easier because now we just need to remember what assertions relate to what category, okay? And I think the most interesting thing here, O is for cutoff. O is for cutoff, and notice cutoff only relates to what? Only relates to the transaction and events which are related to which we said are the current years led journals. Cutoff is, did a transaction get recorded in the appropriate year, right? And so we'll pick transactions that happen near year end and just into the start of the next year to make sure they were included in the proper accounting period. So again, the important thing is that you know what categories these assertions fall in. So I have asked you to go ahead and flashcard that. And you know, the interesting thing here is cutoff, and then the R. What's the R? Rights and obligations. Notice rights and obligations really focus more on the account balance, because we're saying if you're recording an asset and it's sitting there from whatever year it came from, do you have the full rights to that asset? Okay, if it's a liability from whatever you came year, are you truly obligated for that liability that's being discussed there? Okay, so it is important here, guys, that you know the assertions. Okay, you know what category they fall in, but the most important thing is, can you line up audit procedures? Okay, and guys, these are substantive procedures, because there's also control procedures. Can you line up substantive procedures with the assertion? Okay, so let's look at some of this, since this is really where we're gonna really need to get strong in lining up procedures with assertions, particularly when we start looking at some of the actual account balances here. When we get into chapter 4, it's going to be key that we understand how to audit the assertion rather than just memorize procedures for an account, because accounts are made up of assertions. Okay, so let's look at some of these. And I've already said to you that for what? Existence, confirmation is the classic, isn't it? Okay. Now, notice they say that for existence, you go from the financial statements back to supporting documents. Notice I'm not highlighting the word vouching, because I don't want you to memorize the word. I want you to understand the direction, right? When we look at completeness, okay, notice that for completeness, they tell us that we should start from the source document and go through to their ultimate recording in the financial statements, right? Just like we talked about, okay? Cutoff, we're looking at transactions before and after year end. That's why it's only in the transaction category, because we want to just make sure that that transaction that happened near year end and just after year end were appropriately recorded in the appropriate period. Valuation and valuation, allocation and accuracy all deal with accounting estimates, don't they? Do we really know that the depreciation is calculated correctly? No, right? It's an accounting estimate. Okay, so what do? We go ahead and they kind of buried it in here, we recalculate. Recalculate is the way to audit accounting estimates, which are embodied in the assertion, valuation, allocation, and accuracy. Okay, rights and obligations. Okay, inspection documents that support that they own something, they have a contract, they have an invoice for it, whatever, right? And then understandability and presentation, really review related disclosure for gap compliance. Most audit manuals and whatnot, audit guidance will have what they call a disclosure checklist. And it allows you to go through and tick off to see that the entity has made all the required disclosures. And of course, the more experience you have with the client, the better that list will be, right? And that's how you'll look at related disclosure. So I want you to flashcard this, because this is good. This lines up assertions with audit procedures, and you could probably shrink this down and just go ahead and flashcard this and have this in your flashcards, okay? And maybe highlight it first, then copy it, then flashcard it, so that you can kind of see some of the notes that we made here, okay? Now, this in and of itself, though, is still not enough. And I'm going to show you this thing one more time. I think this is the last time I bore you with this thing, which is, it's about what? It's not, it's the assertion, but it's what? It's also the internal control, right? So it's not just substantive procedures, it's also control procedures that would have prevented or detected that misstatement that are part of this overall process, right? What's the potential misstatement? What is the control? What is the risk of material misstatement? Respond accordingly. If I've assessed the risk of material misstatement to less than the maximum, I need to test the operating effectiveness of the controls. And then I respond accordingly with the timing, extent, and nature of my substantive procedure, right? Okay, so I think this is good that they finally, I don't know why it took them all the way till now to line up audit procedures with assertions, but that's the way it's done. But it's also, then they left out the important consideration of the internal control relating it to the assertions. Okay, all right, so with all that, let's take a look at some questions. Okay, it's about 2 minutes now, so let's go ahead and take a look at this question. And okay, decent results. Pretty much all of us got the answer correct here. Now, when you look at this one, because the answer is C. Okay, now when you look at this one, let me ask you a couple questions here. They say test of details. And when they say test of details, what does test of details constitute? Two things. I
That'd
think,
be what
go ahead, Michael.
you would want to like confirm account balances or confirm transactions.
Okay, well, yeah, you're a little more detailed, but not quite as specific as I wanted you to be, if that makes sense. Well, confirming of account balances, what type of test of detail is that?
Existence.
Okay. Confirming account balances, though, what kind of a test of details is that? That's the assertion. Okay, there are two types of test of details.
Positive and negative confirmation.
No. Two types of test of details. Control tests and substantive tests. Both are considered test of details, right? I said I wouldn't show you this again. I guess I'm going to. When we are in the testing phase, we are testing the details, and we are testing both the control test and the substantive test are both considered test of details because we're in the testing phase. Okay. Now, when you look at this question that almost everybody got right, so I may be overkilling here. Okay. But when you look at this question, they say test of details performed as a substantive test. So maybe I'm not overkilling, because you might say, well, why are they saying perform? If you only thought test of details was a substantive test, you might get confused there, right? Okay. Now you look at this and they start to list things. Now look, you know, the objective of no test is to comply with generally accepted auditing standards. The objective is to have an audit outcome. Okay, not just comply with the standards. Okay. Now, when they say attain assurance about the reliability of information system relevant to financial reporting, well, if we're looking at the reliability of an information system, that's probably going more towards what? Some sort of control test. Okay. Now, when we say detect material misstatements, which is the correct answer, well, what happens? You do your substantive tests, and your substantive test would be up to lower what?
The risk of material misstatement.
No. You do substantive tests to lower what?
Detection risk.
Detection.
The lower detection risk, and that would have been based on the response to your assessment of the risk of material misstatement. So you weren't too far off base, but it's to lower detection risk. So I guess you're doing it so that you can detect material misstatements, which is the correct answer that almost everybody got. Okay, evaluate whether management's controls are operating effectively. If the controls have operating effectiveness, how do we get evidence to support operating effectiveness of the controls?
Control test.
We do control tests for that. This was asking me about substantive tests. Okay. Okay, good. So you see, guys, the way I've been describing this stuff to you, those other documents that I supplemented with, are you seeing the importance of this whole, you know, not sitting here and chopping up halfway things we've heard or we thought we've understood? You've got to get that sort of overall feel for this stuff and how the language fits in. But once you accomplish that, this test is a piece of cake. you will probably be finishing this test faster than any of the other exams because you will have the correct words, you'll have them in the correct context, you'll practice with questions like this, using the words in the correct context, and then you'll get better and better and more refined at that, so that by test day, I'm expecting that you're going to be blowing this thing away. Okay, but you got to put in that, upfront work on it. Okay, good. Enough of that speech. Let's go ahead and let's take a look at this next question. Okay, guys, we're coming up on 2 minutes here. Let's go ahead and let's look at this question, the results here. And not the best that we've done tonight. The majority of us got the correct answer, but let's go ahead and let's work on this a little bit, because this is not the easiest question we've had all night. So let's look at this one. And auditors try to identify predictable, plausible relationships using analytical procedures. Which of the following accounts would most likely yield the highest level of evidence using an analytical procedure? When we look at analytical procedure as a substantive test, we're looking to see the least amount of noise between whatever data we're looking at and the information that we're trying to get evidence on in the financial statements. So the first one is accounts receivable. So some of you picked that. What analytical procedure were you thinking you could do over accounts receivable?
I was thinking like confirmations.
Well, confirmations are a test of detail. They're asking me about analytical procedures here. I know there's a couple other people that picked account receivable. Okay, well, look, I might be able to look at what the amount of credit sales, the number of credit sales that they've had, and get some feel for what should be the account receivable. If the average sale is this amount, the average amount of the credit sales is this amount, then that should yield the accounts receivable. But the problem I have is what? Well, what about the cash sales? So they might also have cash sales, and I'm all of a sudden going to be burdened with what? Potential noise there as to that they had some sales. Here are their sales, but I got to tease out, well, which ones were the credit sales, which one were the cash sales. This lends itself more to a test of details, right? Okay. Now, accounts payable, well, again, what if I have what? What if and you can say, well, get comfortable with expenses, that'll help you with accounts payable. Well, what if it was an asset that they acquired and there's an account payable? What if they had paid cash for some of their expenses? So again, there's potential for noise there, right? Okay. Travel and entertainment expense, I mean, there could be all kinds of variables there that wouldn't lend it to an analytical procedure. The correct answer, interest expense. I've got a nice analytics set up there. Get comfortable with the debt. If I'm comfortable with the debt, I should be able to predict what the interest expense is, right? A balance sheet and an income statement account. Okay, so when you look at these analytical procedures, you're looking for something that gives you the best cause and effect result. Water bill, washing machine revenue, debt, interest expense. Okay. Okay, good. Let's look at this next question. Okay, we're a little under the 2 minutes, but it looks like most of you have had a chance to take a look at this, okay? And so most of us got this right, but let me ask you a question here. They say, in determining whether transactions have been recorded. So if we're trying to determine if a transaction has been recorded, meaning they didn't forget to record it or fail to record it, whatever, okay? It's been recorded, they didn't fail to, they recorded it. What assertion are we talking about?
Completeness.
Completeness. If they forget, fail to record something, the records aren't complete, right? Okay, so if I want to make sure the records are complete, then I'm not going to start, which I think one person picked, with the general ledger because it's already in the general ledger. I'm worried that it maybe is not in there. So what am I going to do? I'm going to start from the source document and try to find it in the financial statements, right? Notice I'm not using the word trace there to describe that process, nor did they mention the word trace. That's why I don't want you to sit there and get used to looking for a word that may or may not be there or may not be used in the context of the way we described it. They may use the word trace when they're asking you about existence. Question. You got to get good at this kind of question. And most of you are pretty good at that. Now, the next module, I am not going to go through with you. It is ratio analysis, okay? I don't see a whole lot of use in me sitting here and walking you through a listing of ratios that you're going to have to use financial statement information to figure out these different ratio. But you need to flashcard and memorize every single ratio. Every single ratio, because what they will, what I had a dream that the examiners do is they give you a financial statement like this, And then they ask you about a bunch of ratio, okay? And they do that in the context of a task-based simulation. So you've got a balance sheet, you've got an income statement like this, and then they're going to start asking you to rattle off a bunch of ratio. What do you want me to tell you? Divide current assets by current liability is the current ratio, but you got to know the ratios. Now, I'm pretty sure the Becker flashcards that you acquired along with your package here have these ratio, but make sure you've got all the ratio, make sure you've got to memorize, review this by watching the video, and then be prepared for a task-based simulation in which they may very well ask you to do all these ratio. Okay. All right, I'm going to end there. We are going to deal with audit sampling, modules 8 and 9, and the analytical data analytics, I should say, module next time. And we should have some time left over potentially to start up chapter 4. So we're falling a little bit behind, but I think we're doing a good, thorough job of getting through this information. So I just want to continue that pace. Okay. Question?
Can you post chapter 4? I'm still waiting for my books to arrive from Becker. And I
Okay.
did contact them, and they did provide me with a tracking number. And after I requested it 2 weeks ago, but they're just now sending it out yesterday.
Okay. Okay, good. Well, I'm glad you followed up because what I was going to say is I've asked several times, tell me if you haven't gotten your book so I can get somebody on that. But since you followed up and you got the tracking number, I don't need to do that. But okay. Okay, yeah, I'll post up chapter 4. Anyone else who has not received their books? Okay, good. Okay, so yeah, I'll put that up though for next time. Okay, and I'll catch up on the recordings too. All right, guys, we will see you next week. Study hard, get that homework done. We're through. You should be able to be through module 7 of chapter 3 at this point.
Thank you. Have a good night.
All right,
Thank
thanks,
you.
Mark.
Have a good
Thanks,
night.
guys.
Yeah.
Good work. Have a good night.